Seven-figure earners have a unique ability to do really great tax planning. Hi, I'm Thomas Kopelman. I'm a financial planner that works with seven-figure income earners. And in today's video, I'm going to walk you through the hierarchy of how to prioritize different investment accounts. Let's go through it. The first one is solo 401k or a 401k or whatever your company-sponsored retirement plan is. So if you're an employee, you're making seven figures, your 401k is one of the best tools that you have. So you can put in $23,000 on the employee side, and then you're going to get a match. So let's say the match for you is a flat 10K. So you're at $33,000. That is a great tool. You also have the ability to do Roth if you want to. For most high income earners, deferring taxes today makes sense as long as you have a strategy around how you're going to get that money to Roth via Roth conversions. I've done videos on that. Go check it out if you really want to learn about Roth conversions. Now, if you are a business owner, I work with tons of solo business owners, then you have the solo 401k. Such a great tool. With the solo 401k, you're able to put in $23,000 on the employee side, and then you get all the way up to $69,000 total, so $46,000 through the employer side, as long as you have a salary that's high enough. You would basically need to have about $184,000 salary because you can put in 25% of that W-2 salary if you're an S-Corp. If you are a sole prop, then you can put in 20% of business profits. So the first account is your company-sponsored retirement plan. The second one is going to be your HSA. So an HSA is a health savings account. This is a tool that only is available to people that have a health plan that qualify. For a lot of high income earners, HSA eligible plans do make a lot of sense. It has a bunch of good benefits. It reduces your taxable income. You can invest those dollars in it, grow tax deferred, and then you can use it tax free as long as you have healthcare expenses, or you can save receipts and reimburse yourself later down the line. But in reality, for most people, healthcare costs in retirement are a lot. So you're going to have plenty of expenses, and your HSA is a great retirement account that can be used for healthcare costs. The problem is most people use their HSA this year like it's an FSA, when in reality, you have plenty of extra money. It's oftentimes better to pay with your after-tax dollars and let this HSA money grow tax-free, right? This is the most tax-efficient account. No other account has deduction, growth, and use tax-free as long as it's used for healthcare. So that's number two. The third one is an ESPP plan. So this is just an employee stock purchase plan. So let's say that you work at a publicly traded company. They'll say, hey, you can buy $25,000 worth of our company stock. And a lot of times they have a discount. So this could be a 15% discount. A lot of my clients have a 15% discount. And then they have what's called a look back period. So what that means is, let's say January is when the period starts, and then it ends 6 months later in July. It holds dollars in between this whole time. And then if it has this look back provision, it's going to buy at the lower price, either at the start date or the purchase date. So let's say it was 100 here and it's 120 now. It's going to buy at 15% off that 100. So you're going to get the stock at $85, even though today the stock is $120. This is a really great tool. If you have one and it doesn't have a match or it doesn't have a discount, that changes it. But 15% discount is a 17.6% rate of return. That's something that you definitely want to look in and consider. So the next one is a backdoor Roth IRA. If you're a seven-figure earner, you're not going to be able to contribute to a Roth IRA. If you've directly been contributing to a Roth IRA over the last few years, you need to take a break and you need to go fix that, because for every month you're accruing a penalty for putting in dollars that you can't. So if you're over the income limit, you can do what's called the backdoor Roth IRA. To do the backdoor Roth IRA, you put funds in a traditional IRA, you don't deduct them, which you can't. You make too much money to deduct them, and then you convert it over to Roth. Because you never deducted it, it's an after-tax contribution, that conversion is tax-free. If you wait a few months and there's some growth, then any of the growth you're going to pay income taxes on. A few things that you need to know about the backdoor Roth: the pro rata rule. So let's say you had a rollover IRA with $7,000, that's already pre-tax, and you want to do the backdoor Roth IRA with $7,000. The IRS doesn't just let you choose this side. They say you already deducted $7,000, this one's after tax, so because 50% of your IRA money is pre-tax, 50% of the backdoor Roth is taxable. The way that you get around this is you move those funds into a company-sponsored plan. This could be a solo 401k, could be a regular 401k, whatever option you have. If you roll it into there by December 31st of the year you want to do the conversion, then this is not taxable. What accounts trigger the pro rata rule? Traditional IRA, simple IRA, SEP IRA. So if you want to do the backdoor Roth, You have to make sure that you have $0 in your traditional IRA balance at the end of the calendar year. Okay, and now the last account is your taxable brokerage account. Now you've used all of your tax advantaged accounts out there. Every dollar is already after tax. The best place to go put these dollars now is to a taxable brokerage account. Taxable brokerage account has favorable tax treatment. If you sell the investment within a year, then you pay short-term capital gains, which is the same as income taxes. Wait more than a year, then you have long-term capital gains, which for any seven-figure income earner is going to be 20% Fed, 3.8% net investment tax, and then you're also going to pay some state taxes depending on where you live. That's still a lot lower than income taxes. So this is the account that you want to build. This is how you pay for college and how you pay for weddings and how you retire early before you can take money out of that account by age 60. And when you have a taxable brokerage account, you really want to focus in on being tax efficient, investing in a way where you're not having a lot of income flowing through to your tax return. Time and time again, I see high income earners focused in on cash flow with their investments, and all you're doing is choosing to pay anywhere from 37 to 50% tax depending on what state you're in, and you don't need cash flow. When you have a lot of income and a lot of surplus, you want to focus on growth, not cash flow. When you get to retirement, that's when you can start to think about cash flow. But right now you're just having this huge tax drag when you're paying anywhere from 37 to 50.3% depending on what state that you live in. The way that I think about this in order of priority is 401k or solo 401k, then HSA, then ESPP if you have it. It's going to be a small segment of people. Then it's going to be Roth IRA or Backdoor Roth IRA. The one that I'll caveat that I'll add here before taxable brokerage is if you have the mega backdoor Roth. So let's say you work at Uber or some company like that, and you put in $23,000 in your traditional 401k, they match 7, you're at 30, you have $39,000 of room left. And so the mega backdoor Roth 401k allows you to put money into the after-tax 401k, but then you need to convert it to Roth. And because it's after tax, that conversion to Roth is not taxable unless you have growth in there. If you have any growth, then that counts as income taxes. But this is also a really, really great tool. And then the last one is a taxable brokerage account. Again, if you are a high income earner, this is going to give you pre-tax. It's going to give you Roth, and it's going to give you taxable, which is going to create a lot of tax diversification along your investments. For a lot of people watching this, they're like, how can they do all of these accounts? Well, in reality, the average high income earner that's making 7 figures should be able to do them all, right? 401k is $23,000. If it's a solo 401k, sure, it's $69,000. Then you're going to have your HSA, that's only $8,300. Then you're going to have the backdoor Roth, that's $7,000 for each of you. So this isn't even getting you to investing a large part of your income yet. You're 5 to 10% of your income you're investing. And I believe everybody should be investing at least 20% of their income. And then now what people say is, well, should I have different investments inside of different accounts? You should. With all of these pre-tax accounts, when they're going to grow and you're going to pay income taxes when you withdraw them. So that's going to be higher than capital gains. It's going to be higher than tax-free in a Roth. So you want the lowest growth assets in your investment portfolio there. Let's say that you have a high risk tolerance and you have no bonds. Well, then that's different. But if you have 20% bonds in your portfolio, it might make sense to have a majority in these pre-tax accounts so they grow less because of the income taxes that you're going to pay later. Then you want your highest growth assets in Roth. Why? If you're not going to pay any capital gains down the line, you want that account to grow as much as possible. And then your taxable brokerage account, think about your risk tolerance. Second, you want to think about time horizon. If you're going to need this money in 5 to 10 years, you're going to have to invest more conservatively than if you need this 20 years from now. And then inside of that account, you do want to focus on being tax efficient. So if you were going to have some muni bonds and some taxable bonds are going to make way more sense inside of a 401k. Muni bonds are going to make way more sense in a taxable account because you're not going to have to pay those federal taxes on it. You want to think about your investment portfolio as one thing and then place those assets in the right accounts based on your goals, based on, taxes and all of those other things. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.